Hey, what's up guys? John here. The Fed is intentionally forcing banks to go insolvent. Some of the biggest banks, their stocks are already crashing due to what is happening right now in the economy. But I'm going to show you what the future is going to look like with bank lending. If you have a business, if you're someone using a credit card, you're looking for any type of loan, you have to pay very, very close attention to what's going on behind the scenes because they don't want you to know about it. They want you focused on Israel and Hamas, Russia and Ukraine, the UFC deal with the Bud Light sponsor. They want you focused on all these little things, all these events, all of these, disasters that are happening on the world. Meanwhile, they're completely overhauling and restructuring the banking system as we know it. I'm going to show you what's going on. Look at this. Bank of America down, Wells Fargo down, JP Morgan Chase down, Citigroup down. I'm going to show you the facts. Please hit the like button. When you hit the like button, YouTube will share this content, educate more people about what's really going on in America. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com by scheduling a free strategy session by clicking the link in the description below this video. Take a look at this. So, first and foremost, Consumer Price Index. This is the purchasing power of the US dollar since 2020. You can see this deterioration as do all of the policies that have been enacted the last couple of years. Now you're starting to see car payment defaults hit a 29-year high, almost a 3-decade high. You're seeing the same thing. Subprime borrowers' delinquencies up as credit line grows, right? You're seeing all these problems happen. Disposable income is coming off of a cliff, and this does not factor in student loan repayment that started. So you can just imagine what this is going to do. The average payment is $504 a month. 2 out of 3 Americans, they don't have more than $400 in the bank. So you start to see what's really going on here. It's a crisis that's unfolding in America. And banks, they're sitting in a very, very delicate position. And what is the Fed doing? They're taking advantage of this to enact all of the new regulations, this new overhaul of the economy they're working on. So personal savings rate coming off of a cliff as well. Look at this. You have commercial real estate. $1.5 trillion of commercial real estate has to get refinanced over the next year or so. Right? $1.5 trillion. You have a $20 trillion market, and by 2027, 1 in 10 properties in the country will have to get refinanced. What does this mean? This means that these owners of these properties, on a traditional residential, 1 to 4 unit property, most of these loans are a 30-year fixed, meaning the loan is what the loan is for 30 years until you pay it off. With commercial, it's not that way. 3 years, 5 years, 7-year loan term. After that period, you have to go back to the bank. The bank is going to look at the income on the building. They're going to run an appraisal. They'll tell you what they think the property is worth, and then they will tell you what they will lend on it at that time. Well, given what's happening right now with mortgage rates and commercial real estate, values have fallen dramatically. So many of these investors are going to have to actually bring cash to the table to be able to hold on to the deal. Otherwise, the bank is going to take over the deal and essentially foreclose. So this is going to be a massive crisis that's unfolding right now, and a lot of that debt, a lot of that exposure is held by these banks. And Fed is signaling they're going to keep interest rates higher for longer, right? So you can see the pain that's coming. But look at what they just announced today. Today, Fed wants to lower swipe fees for a potential blow to banks and credit card giants. So what does this mean? Every time you swipe a credit card, you go to the store, you swipe a card, the merchant, they might pay 10 cents, 50 cents to be able to process that transaction. Now they are saying that on a $50 transaction, it would basically cost them 17.7. Well, they want to move it to 17.7 cents. Now they're paying about 42 cents. So they want to be able to reduce the fees that banks and credit card companies are charging by about 70%. So some people might say, hey, that's a great thing. Reduce these fees. Well, when you have a situation like what we're walking into right now with all of these defaults happening, if you're a credit card company and you're making less money lending money because you're getting less on those swipe fees and your defaults are continuing to rise, what are you going to do? You're probably going to lend less money, right? You're probably going to lend less money to people that are quote unquote high risk, which is most of America right now. And so what are they going to do, right? It's going to take a lot of their ability to make money off of the table. That's what's going to happen. And they're pushing this forward. As that's happening, they're unveiling this new banking regulation. And this new banking regulation, by the way, this will essentially change the way in which these traditional banks are able to operate. These small regional banks, before they were able to gauge their own risk. So they can go out there and say, you know what? We will lend to who we want to be able to lend to. But now they're saying that banks will no longer be able to act as their own risk managers. So they will have to, under the new rules, banks with $100 billion or more in assets won't be able to use their own models to determine the risk they've undertaken on loans and other activities. Their risk level assessments have been the basis for informing how much capital they need to hold on top of their baseline requirements and accounting for unrealized losses. They're essentially going to change the way that these banks are operating. So as that is starting to happen, what are we going to walk into? We're going to walk into a big change. But look at this big problem that they're walking everyone into right here. Again, this came out today. Under the radar, nobody's talking about it. Prudent demand, we act. Bank regulators unveil climate rules. So these new climate rules says U.S. banks will face pressure to address the financial threats of climate, including underserved communities under 2 new sweeping regulatory activities. They basically, what they want to do is they want to make sure that they're not going to be lending money recklessly on businesses and on real estate that are in areas that are either emitting a lot of emissions or they are quote unquote high risk and they essentially could lose money on the loans because these assets are worth less given the fact of what's happening with the climate. This is what they're saying. So they say, final rule including provisions to explicitly incentivize banks to help redline communities weather climate fuel disasters, potentially spurring billions of dollars in investments in everything from flood control systems to seawalls. New guidance, meanwhile, sets regulatory expectations for how large banks should measure and address their exposure to climate-related financial risk. We should not wait for a disaster to strike. They go on to say right here that the 3 agencies will jointly finalize long-awaited guidance to support large lenders' efforts to account for climate-related financial risk. The guidance says any bank with more than $100 billion in assets should infuse climate risk considerations into all parts of their business, ranging from strategic planning, risk management policies, and procedures. For instance, regulators expect big bank boards to understand the company's exposure to climate risk and oversee efforts to address the issue. Boards should also consider climate when determining the company's overall business strategy to ensure any public climate goals are consistent with the bank's actual activities and plans. The guidance also says banks should also begin exploring tools for measure the climate risk exposure, including heat maps, scenarios analysis, climate risk dashboards. They go on to say that the FDIC board meeting that climate is not merely a long-term threat for banks, but poses real financial risks today. He points to recent turmoil in the industry where issuers are hiking premiums on existing communities. So, just like this, if you look at this headline right here, homeowners face rising insurance, right? Insurers withdraw, essentially uninsurable due to the rising. So, climate, so you risk. So you start to look at this, think about what this means. You think about what this actually means. As all of these commercial loans are coming due, it's going to start to become harder and harder and harder to get these loans. Meanwhile, insurance is continuing to rise, apartment construction is at a 50-year high and rents are softening, and borrowing costs are rising. So what are you going to have? You're going to have a dynamic and a situation in which investors that have cash are going to be able to go in there and self-insure these properties, so they're not going to need the banks. And so if there's a large pool of investors that purchased over the last couple of years, they're going to have a hard time getting loans. What does that mean? Small pool of buyers, large amount of investors in a big problem, massive opportunity for investors to walk in and scoop up a ton of property. You look at a lot of the big firms, KKR, Blackstone, BlackRock, you name it, Starwood Capital, they own 180,000 houses. You have all these big firms sitting on $5.3 trillion in cash in money market accounts. You present an opportunity in which these are institutional investors going to take advantage of what is to come, which is going to be a complete restructuring of the entire economy as we know it. You might think, John, this is too much. There's no way. Okay, well, let's look at this. So you have this situation, C40, right? And you look at some of these big names, and then you look at what they're suggesting. You have George right here. Everybody knows George. You have all these really reputable entities, and one of which is the World Bank, right? And then so when you click, you go up here and you click on what we do, and you look at something like ports and shipping, right? Because this would have a very close tie to banks, right? Because you think how banks lend and operate, they lend to businesses, right? They lend credit. what's ultimately going to happen is soon, just like Amazon made this announcement that they are going to start to look carefully at the sellers in which they do business with, the amount of emissions that they emit to the environment, and they're going to start to reduce their dependency on these shippers that do not comply with stage 1, 2, and 3 of the new emission standards that they're pushing forward. So when you look at this, you're like, okay, you click around and you start to pay attention to this. If you click on learn more about ports and ships, you will see right here, ports and shipping, that they say ports and their host cities are under threat from sea level rise, drought, other climate-related risk. The report summarizes the impact and cost of climate and hazards and estimates the potential global cost of climate for shipping, ports, and port cities. You're going to start to see everything is going to be pushed onto banks. And as banks are suffering all these losses, they're going to be able to say, look, we were lending irresponsibly. We need to start to be more protective of the people. This is costing people's lives. This is costing people's ability to live a safe and equitable life. What we need to do, be more careful on who gets loans. We need to be more careful on who can refinance debt, who can get access to credit. This is what's going to happen. It sounds far-fetched. You connect the dots, you will see exactly what the Fed's saying. If you can just look at things from an open perspective, an open mind, and read what the Fed is saying, you'll see that this is actually where we're headed. We're walking into this. It's happening really, really quickly, and the smart and savvy investors are preparing for it. It says, the FDIC is not responsible for climate policy and does not tell banks which customers to serve. However, financial institutions should fully consider climate-related financial risk as they do all other risks and continue to take risk-based approach in assessing individual credit and investment decisions. You tell me, what do you think is going to happen? You think this is going to happen? I would bet everything on it. I'd bet 100% of everything that this is where we walk into the next year, 2 years, 3 years, 4 years. It'll be a death of 1,000 cuts. So if you are a business owner, if you're an entrepreneur, you're a business person, just take this into consideration, because what I believe is going to happen is smart people make smart decisions, base things on fact. Everyone else ignores things, bases them on emotion, how it makes them feel. The facts are the facts. This is what we're walking into. Position yourself accordingly. Put yourself in the best position possible to get access to money, because most people won't. And then you'll put yourself in a, up here while everyone else is down here wondering what happened. What do you think? Drop below. We'll have a conversation about it. If you'd like to fix your credit, we'd love to help you. My company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any problem on your credit report, go to GreatCreditFast.com. Click the link in the description below. Catch you in the next one.